Hi, this is Colin Richards, president and founder of Lord & Richards. And in this particular segment of our show, we're going to continue our theme, which we've entitled When Everything Goes Bust. And we've already looked at it in a prior segment from the perspective of what the Bible has to say, how to bring a generous spirit to that. But today we're going to talk about what it means to face the uncertainty in our world, especially right now in our stock, our equity, and our bond markets. Okay, so when you own a stock in a company, you share in that company's good fortunes, whether up or down, whether good or bad. If you own bonds, you also somewhat share in that company's fortune. You've basically lent money to that corporation, which is paid over time. Usually, those two markets really respond differently. They're quite a bit different. Portfolio managers tend to use bonds to mitigate against losses that might occur in stocks because they move in different directions frequently. This is generally. Generally speaking, they don't go down at the same time, right? You don't typically see the whole stock market go down at the same time that bonds are going down. And normally we see bonds as something really less volatile than stocks, right? Stocks, equities, having ownership in a company is a more volatile, a little bit more of a wild ride compared to lending, which is considered a more stable platform and also may generally have lower returns, although there are certainly ways to invest in bonds that yield higher returns. But what's interesting is that for the first time in almost 50 years, with data going back to 1976, both stocks and bonds have come into correction territory at the same time. Let me explain what I mean. First of all, a correction is loosely defined as when a market, stock market, bond market, an index, or a stock, when it goes down more than 10%. When we reach that threshold, now we're in what we call a correction. When we see that same index, that market go down more than 20% or 20% or more, we typically call that a bear market, right? So we have corrections and bear markets can go much further than minus 20%. Well, what we've seen is that our stock market has reacted dramatically to world events in a way that we did not see during COVID. All the optimism seems to have deflated out of the stock market. But the problem is, instead of enjoying the relative peace and safety of bonds in our portfolio to offset some of those stock losses, people are seeing their bond portfolio also go down. So instead of kind of a counterbalance, both are dragging on the portfolio. This is affecting everyone who has used bonds as a strategy to mitigate risk. Articles are coming out left and right. We see the S&P has gone down. It was nearly into bear market territory recently, but about 15% at the time of the article that I'm referring to. You can find it in Business Insider, and it came out just, the first part of May 2022. And it's highlighting this unique, unforeseen series of events. The U.S. aggregate bond index is also down over 10%. So to see both of those indices, the stock market index represented by the S&P 500, to see the bond market index down as well from its high. And then here's the real kicker. A lot of times folks will move into long-term bonds issued by the government, considered some of the safest investments in the world, to further decrease volatility in the portfolio. And that's, a treasury is a really safe investment, right? We call it a risk-free investment because it's backed by the strength of the United States. Whole other conversation there. But as a risk-free return, it's supposed to be stable. But that's if you buy the bond, you hold it to maturity, you get paid your interest, and then at the end, you're done. But in most investors' portfolio, you don't own individual bonds that you're going to hold the whole length. You need some liquidity. So you own baskets of bonds in mutual funds or ETFs, which are called exchange-traded funds, and so forth. Well, the problem is that the value of those bonds are dependent upon the price inside of those funds. And right now, we've had a situation where the government has been raising interest rates to combat inflation. So you've got a 1-2 punch. We've got inflation up over 8.5%, and we've got the government raising rates, albeit very late, according to Ben Bernanke, too late, in order to combat this inflation. So we're leading probably to a recession in the near term. Very, very hard to have what they're calling the soft landing in our economy with the rapid pace of interest rates going up. And you're seeing this everywhere. The cost of a home is much more than it was just a year ago, not only in price, but also in your monthly payment reflected in your interest rate. Over 5% now for a 30-year mortgage compared to less than 3% not that long ago. Really amazing. And here's how it works. Here's why your supposedly safe bond portfolio isn't looking as good. If you have a bond and the interest rate that it's paying you is 5%, and somebody comes along with an equally safe bond and they're going to pay 6%, suddenly your bond doesn't look so attractive. As a matter of fact, the value of that bond's gone down 20%. So you're going to have to sell at a discount if you want to get money out of those bonds and use it for other things. In other words, to create liquidity, you're going to generate a loss. That's a 20% loss. And that's exactly what's happened on long-term treasuries. 20-year treasuries are well represented in the market by an ETF called the TLT. And you can look it up. It's been down over 20% year to date. Wow, what an amazing turn of events. And over the last few years, we've just seen hit after hit after hit where things are happening that people have not been expecting at all. And here's the reality. What we need to do is, instead of relying on just the age-old advice, have about 60% of your portfolio in stocks and about 40% in bonds, and you should have a reasonable degree of risk. What we need to do is start with a great conversation about risk. And this is what happens when folks visit with us at Lord & Richards. We sit down and we use some really carefully prepared exercises to help you determine how you feel about risk, not what we think you should feel, and then guide you to a portfolio that can actually keep you within that risk and not just fictitiously, right? Just throwing darts at a board and hoping it works out. Here's the solution. You need non-correlated assets in your portfolio. That's the truth concerning bonds, stocks, and their supposed balance. That balance sometimes goes way out of whack like we're seeing now. You need to add in something else, right? It's kind of like a two-party system in investing. It seems like we've gotten stuck. There's a lot of articles, you can look them up, that say the 60-40, 60% stock, 40% bond portfolio is dead. Well, I don't know if that's the case, but what I think is that the 60-40 portfolio is generic. It is not tailored to your needs, and it needs to be adjusted to reflect how you feel about risk. What if we could add into your portfolio assets that don't move up or down just with the stock market? They are completely non-correlated, and in addition, they're principal protected. See, this is a key piece that most people are missing. We know what it is to put money in cash and keep it safe. We know what it is to put in stock market and bond market and take risk. But what most of us have never learned how to do is to achieve safety and growth or opportunity on the same dollar at the same time. And the wonderful thing is that this has been available to people like you and me, not just billionaires, not just huge hedge funds. This has been available to average investors, moms and dads and uncles and aunts and so forth, for decades now. The tools are there, and we've been using them at Lord & Richards, and we'd love to show you how you can use them to reduce risk and still keep the opportunity for growth. It really just starts with a conversation. As we talk to people just like you every single day, what we've been wonderfully able to do is sit down, visit, learn about your goals, and develop a comprehensive written plan so that you not only achieve those goals, but you do it in a way that doesn't cause anxiety and fear. It really just starts with a simple conversation.